No one's watching. They're not listening.
We're done.
No, come on.
Come on,
Carry
no.
on singing.
No,
No, you can't start seconds before we come back.
Look at that. NASDAQ future is poised to eke out just a little gain. Come on, keep going.
You're not going to sing us into the opening bell?
Come on.
Unbelievable. Up a third of 1% on the S&P. NASDAQ futures up 0.4%. Big move lower. Closed almost at the lows in yesterday's session. Tiny bounce. In the FX market, euro just a little bit stronger, up by 0.2%. Stronger against the US dollar. And yields higher by 3 basis points on a 10-year. 343.72. Twos this morning, Tom. 343.80.
You guys have been on the 2-year today, and you're correct on a standard deviation basis. I want to point out the VIX didn't pop to a 30, 31, 32. The VIX was like a 27-ish, and that's not, as I mentioned earlier, we reset. We did not collapse.
Am I getting a song?
Oh, I see.
There we
right,
go. That was beautiful. That's enough. That's special.
That's okay.
I can clip that now and put it on repeat.
Great, thanks.
Joining us now with some stocks around the opening bell is Abby. Hey, Abby.
Much better that you're singing than me, Lisa, for sure. And I can't believe, John, that you've never heard that song. As for stocks, we do, of course, have a little bit of a rebound after the worst day since March of 2020 for the NASDAQ 100. That has everything to do with the fact that your Apples and Microsofts are higher on the day after the worst day for Microsoft and Apple, going all the way back to September of 2020 on that surge in yield. Occidental Petroleum popping 1.2% up with oil, so it's a little bit of a broad-based rally. You also have your banks higher. JP Morgan had been up a little bit more earlier with yields higher. We would be remiss, though, if we didn't talk about the railroads, because, of course, there is the possibility of a strike if a deal is not struck by Friday. 100,000 workers may go on strike. If that happens, John, of course, it would mean rising prices in the form of higher shipping costs. The railroads on the day are down, including Union Pacific.
Abby, thank you. Got to turn to the inflation story. Big upside surprise yesterday. That print fueling the biggest day of declines in more than 2 years on the S&P 500. Katie Lyons has more. Hey, Katie.
Yesterday was an absolutely brutal day, but it was more brutal for certain areas of the equity market in particular. Brutal, Tom. Yes, indeed. The likes of the home builders, consumer discretionary, technology, all the big laggards on the day yesterday, although this morning they are seeing the smallest of rebounds. Still very, very small. In fact, the home builders now turning negative, as is the case for some of those retail stocks as well. Obviously, even the gains of today we're seeing for the likes of technology doesn't do much to unwind the pain of yesterday. The home builders, for example, down 7% on the day. Retail and apparel each down about 6%. You have the tech names down in the ballpark of 5% as well. Crushed, brutal, whatever you want to call it. It hasn't just been a one-day story. It has been tough going for these stocks really since we saw inflation first become elevated in May of 2021, and for obvious reasons. The home builder decline of about 21% since that time period goes hand in hand with the idea that if inflation is high, the Fed has to raise rates to rate it in. That means mortgage rates go higher and housing demand cools. We've already seen that borne out in the economic data. And for consumer discretionary and tech stocks, we know that that is because a lot of those stocks command higher multiples. And when you command a higher multiple and rates are rising, that value of earnings going forward that so much of your price is based on is devalued, which is why we've seen a lot of these stocks coming back down to earth. And of course, that is a higher rate story, which brings me to the bond market. We have seen so much work done in treasuries on a year-to-date basis, specifically at the short end with the 2-year yield up 300 basis points or more since the year started, up nearly 200 basis points for the 10-year. But it's not just nominal yields really that we need to look at. It is real yields, inflation adjusted. We are very close to 1% on that 10-year real yield, John.
300 basis points year to date on a nominal 2 year. Unreal. Katie, thank you, by the way.
And to get where total return is, this is really important. Insane. No one is prepared for the simple breakdown in price of the Bloomberg Aggregate Total Return Index. We're not there yet. We're close.
Grandma, that move is phenomenal, isn't it? It really is.
Especially considering that for years people were saying that this economy couldn't withstand a 25 basis point rate hike or 50 basis point rate hike, and suddenly we're climbing very quickly and we're seeing a real shift as people expect that much more.
Compare and contrast this cycle, this rate hiking cycle, to the last one.
Yeah.
How much they did over, say, 3 years, and how much they've done in 6 months.
Front loading, right? But when do we see the actual effects, and how long does it take to trickle into the economy as well?
Well, we've asked the question, haven't we? Front loading or just delayed and catch up?
What was it? Christine Lagarde? Who was that?
Yes.
Jim Bianco?
That was Jim Bianco.
That was brutal.
Bianco Research. You're going to play nice today. You're going to play nice today.
I just thought what Jim Bianco said was brutal.
I agree. Brutal's the word of the day. JP Morgan's Oksana Aronoff joins us now alongside Samir Saman.
They're both brutal.
Global market strategist at Wells Fargo Investment Institute. Oksana, let's go first to you. Are you seeing any value in this market yet?
Well, first of all, let's level set. Tom mentioned the performance of bonds year to date, and for the global aggregate, the Barclays Global aggregate, bonds are right up there with equities. Equities in the U.S. down 17%, at 17.5%, and global bonds down almost 17%. I bet you no one could have possibly expected this turn of events. And of course, earlier this year, I've been very, very assertive in my view that it was too early to get into bond risk, and that continues to be the case. And I know that sort of the preferred mantra out there, at least as it relates to credit, is that, the maturity wall is still out there. It's not kind of breathing down anyone's neck. However, it's important to remember that half of all high-yield maturities occur about 2 years before that maturity wall materializes. So happy to talk more about that. But obviously, as stress continues to make its way through fundamentals, through profit margins, and we're starting to see some of that stress, particularly in the leveraged loan space where we are seeing elevated defaults and downgrades, we're going to continue to see now the credit market start to catch up to the realities of high rates.
I'm going to suggest, Oksana, this is original territory, to use the all-time cliche. When we break down under a negative 16% price move, negative 18%, what will be the action of those debt holders? How will they, we've never been here, how will they respond to those simple price declines?
How do you think they will respond? How have they responded in history? Right now,
I'm interviewing you. You're not interviewing me.
I mean, I think we've seen this all play out before, right? Investors do not typically like to sit on losses, particularly not on losses in what's supposed to be the most sort of, bulletproof part of their portfolio, bonds, right? So investors sell, and we know there's research around this. Investors tend to sell at the worst possible time, and that's really going to be the capitulation point, which we certainly haven't seen in the credit market. The credit markets are still pricing well below any sort of recession, and we are increasingly staring at, if not already in, recession. And we're seeing, one of the areas that also gets talked about a lot is the fundamental strength of the corporate market, and I think that is present. However, if you look at the trend, you see that profit margins, yes, they have remained strong in Q2, but if you strip out energy and transportation, which of course benefits from lower energy prices, you see that those profit margins have actually come in at negative 1% quarter over quarter and minus almost 6% year over year for the rest of the lower rated market. And they're led by, lower profit margins in retail, in healthcare, in food. So all the areas that find it very difficult to pass higher costs on to the consumer. And that trend will continue. Profit margins will continue to experience problems, and we will continue to see it reflected in spreads.
So, Oksana, next time we have Zach Griffiths on, we'll bring you on and we'll have you together so we can really get a tit for tat. It seems like you guys have opposing views. Samir Samana, I'd love to get your take on this, because we heard earlier in the program from Zach Griffiths, who is of CreditSights, who is saying that credit spreads have already baked in a significant slowdown, and talking about the maturity wall and the corporate strength. Where do you stand on this? Do you agree with Oksana that there is much more that credit spreads have to widen, that there has to be an inference of greater pain inferred into the credit market than is currently?
I think there's a difference between kind of fair value and kind of where the Fed has to take things, and they probably have to take things beyond fair value just because things are, overheating right now, at least from an inflationary standpoint. So, again, you can have fair value being overshot. That being said, credit spreads right now probably don't fully, kind of embed the reality that's probably ahead of us. If the Fed's going to take, interest rates on the short end to 4.25 by year end, it seems like they're, everybody's on board with front loading now, which should mean the slowdown, the recession probably is in the first half of next year, which is what we've expected for some time. Then credit probably does have one more shoe to drop. Now, that being said, there are emerging pockets of opportunity. I think what's happened with commodities, the fact that oil was, kind of in the low 80s not that long ago, commodities, like energy equities, those continue to be a very small percentage of the overall benchmark. We think there's some attractiveness there. But we would continue to fade, consumer discretionary and real estate. Those are probably both rate sensitive and haven't caught up to where the consumer's health is going.
Given the carnage that Tom and Oksana have been talking about within the total return index and bonds, where do bonds fit in your portfolio, given what we've seen with 60-40 this year?
So we really like the short end, right? You're getting paid to kind of, sit and kind of flip coupons in the short end. We also entered the year most unfavorable on long-term fixed income. We took the opportunity earlier in the year around 3.5 to go to neutral. That's probably a good spot for now. That being said, if you do get overshoots to kind of the 4% area or maybe even higher, I think we would see that as kind of a longer-term opportunity to kind of have that balance in our portfolios because, again, we do believe the Fed will eventually get inflation back down to that 2% target.
Samir, let me just ask you a question on that. If they do get inflation back down to that 2% target, what matters here is time horizon and damage done. Over what time horizon and how much damage will they do to this labour market in between?
So I think it's going to take a lot of time. I mean, you could easily bleed into 23, maybe even 24, and there probably is a good bit of damage done to the labor market. I mean, unfortunately, the Fed's kind of been in this have your cake and eat it too standpoint, where unemployment's only going to tick up slightly, and you're going to somehow get inflation back down. We've just not been in that camp for some time, which is why we remain very cautious on equities. Right, we're underweight small, we're underweight emerging markets, we're underweight developed markets. We're fading kind of the consumer-oriented sectors. So, I mean, we're in a pretty defensive posture. I think we'll get some opportunities to get a little bit more aggressive, but I think we're on the front end of this.
Samir Samana, thank you, sir. It's good to catch up with you. Oksana Aronoff is going to stick with us for a final word. Lisa, that was bearish, and it was kind of the bearish tone we heard from Max Kettner of HSBC when we started the program first thing this morning.
We've heard a lot of bearishness. I mean, it's not
Sure.
just us. People can accuse us of having sort of a tilt in whichever way we want to have it, but this is a reflection of what we're hearing from an increasing number of people, which is why it's sort of surprising that the reaction yesterday was as violent as it was to the prospect that the Fed was actually not lying when it was saying that they were going to raise rates and they were going to raise rates until they saw inflation come down.
Well, the mistake was the rally going into the number. The 4-day rally into CPI, Tom. 5% rally on the S&P 500.
I take issue with the idea it was a crater, a panic, a crush, whatever you want to call it. It was a reset back to where we were
Before
five,
that rally.
6 days ago.
Sure.
That's different than the action. With that said, the way we closed yesterday afternoon was ugly.
Ugly?
Really ugly. It was brutal.
It was brutal. Good. There we
And
go.
yeah, there's no question about it.
We agree on something.
I just remember James Taylor was at an American Economic Association convention.
I didn't know that.
We did a concert, yeah. I think
Okay.
Robert Mundell spoke, and then Taylor got up. He's got the J50 going and that, and he goes in. He goes, "Do me wrong, do me
Oh,
right,
this is special. Okay.
tell me lies, get the inflation call right."
about our
Place roared.
Did you play the guitar?
No, I did not. He played the guitar.
He played the guitar.
Oh yeah,
You can play the guitar.
those diminished chords were something.
And when you make your way to TK's home, there is a guitar in each room, just sort of on the floor. I'm not sure why they're all on the floor. Why are they all on the floor? Why are they not on stands?
There's just,
playing
there's
that.
just always
on the floor
another
in each room.
reason.
I've never understood
I
that.
said to David Gurr, he goes, "What's the next guitar?" And I go, "We can't talk about the D45 Martin that needs to be in the house."
He's set up a whole studio now.
I
Have you seen
know.
this yet?
I
The
have
whole-
seen
the whole
it.
sound
It's
studio.
pretty impressive. It's
Very cool.
his passion.
It's his
Love
passion for when he's not
Why
reading.
was James Taylor at the
Right,
White
history.
House?
I don't know. James Taylor just never made it to the UK. It just wasn't a thing.
That's interesting.
Just wasn't
Like baseball.
Just wasn't a thing. Yeah, we call that rounders.
Interesting.
We call that
Interesting.
rounders, baseball.
sorry,
You just sort of one-handed. You hit a ball and then you run in a circle. That's what we used to play at school.
So, like, if I say,
I'm
John,
told that's what baseball
help me
was
here,
based on.
John.
What? No, that's,
Yeah.
oh my, he is
If I
absolutely
say-
trying to
Yeah,
make
they,
people- no,
they
they were
based
trying-
it on rounders. They did.
You're ignoring me. If I
That's
say the band Traffic,
Not the case, is
do
it?
you know Acoustic Traffic?
No.
Are you serious?
We can talk about it in the break.
James Page?
No.
In these times, it is wrong to receive extraordinary record revenues and profits benefiting from war and on the back of our consumers. Our proposal will raise more than 140 billion euros for member states to cushion the blow directly.
Ursula von der Leyen there at the European Commission just a bit earlier today. She went on to talk about Rounders too and how it's, it's formed baseball later on.
You want me to do this? You want me to do this?
No, I'm joking.
Okay.
Equities are up a half of 1% on the S&P.
I would suggest that
we're firmer by a half of 1% also, Tom.
John, I would suggest von der Leyen is the former defense minister of Germany, is encyclopedic on Germany's ability to help Ukraine.
Yeah.
It's something people don't know. She's
I agree.
encyclopedic.
Also encyclopedic on the mistakes that have been made.
Yes, but she's truly encyclopedic on their military ability.
Oksana Aronoff back with us for a final word over at JP Morgan. Oksana, on Europe, we've had a lot of guests on the program, and they approach the situation in Europe as follows. Not if there'll be a recession, how deep it will be. Do you have the same approach right now?
Yes, definitely. Europe, of course, is dealing with issues that the U.S. is somewhat insulated from. We talk about energy and how energy has let up here in the U.S., for example, but European gas prices are on the rise again. And so, without a doubt, there is definitely a lot of focus on how deep that recession will end up being. And we're seeing it in investors being, to the extent they're underweight equities, are really majorly underweight European equities specifically, right? And much, much less so in the U.S. They're essentially flat in terms of their U.S. equity exposure. So without a doubt, the issues there are much more significant. We're seeing it in higher spreads, slightly more elevated spreads, lower returns year to date. So absolutely.
Right. What's your visibility to 2023? I'm fascinated by the September reset. It's way too early to talk about a year-end review, but do you have any view, Oksana, to how to invest into 2023, or are you just making it up as you go?
I will tell you one thing. I take a lot of issue with what the market is pricing in for next year, which is nothing other than the Fed making a U-turn and becoming accommodative. And it is quite clear to me that the Fed is going to pursue its aggressive stance and eventually become perhaps neutral, but not accommodative. And that's not what our prices are reflecting right now. Someone earlier mentioned our last hiking cycle, the 2015-2018, which was extraordinarily benign. We had inflation at barely 2%. We had higher unemployment, and still we had, for example, lower credit spreads after the last Fed hike back then were in the high 500s, 575 if I remember correctly. And today, when someone talks about fair value in credit, what's fair value? Right now, high yield is pricing significantly below 20-year average. Forget, 20-year recession average. So I think there is definitely a lot of complacency still being placed into this market, being priced into this market, and we need to really be focused on high quality, floating rate, very short, but floating rate preferably, and really wait for that capitulation point. That will be my tip-off to start to really get more aggressive.
Just to put a bow on this, Oksana, how much of your portfolio is in cash-like instruments, and how much have you been building that?
So we came into the year already quite defensively positioned, and we've been building it throughout the year. Yes, we've been tactically trading, the curve and taking advantage of the backup in yields at the front end of the curve. But as far as sort of more strategic, allocation to longer-term risk in the interest rate-driven or credit-driven markets, we've really tried to stay back and actually build our liquidity. We are still, or actually have arrived now at around 70% liquidity, which is, focused again on those high-quality floating rate structures. And we think that that capitulation point will happen. We're just starting to see markets reckon with the reality that this Fed means what it said, with the reality that higher cost of capital is not going to be great for fundamentals. And even this is really important to understand, that we don't need to see, a 2008 or some kind of dramatic recession occur. We just need to see historic defaults or defaults start to move towards historic average in the corporate sector of 3.5%. Right now they're at 1%, to start to see those spreads widen dramatically compared to where they are today.
Oksana, you need to let us know when you're ready to put that cash to work, because we need to cash out when we get to that moment. Oksana Aronoff at JP Morgan. Tom.
In fancy talk, John, 70% liquidity, floating rate. She's on the edge of the triple leveraged all cash fund.
I would say that was pretty gloomy, pretty bearish.
Yeah.
I have to say. That's a lot of cash, Bramo.
70% liquidity. At what
Yeah.
point do they get the conviction to deploy, I think is the right question.
30 minutes ago, the late Queen making the final journey from Buckingham Palace to Westminster Hall. Lizzie Burden's back with us from Abington Green. Lizzie, walk us through the next couple of minutes.
Well, the Queen's coffin is making its way from Buckingham Palace to the Palace of Westminster. It's already been down Pall Mall, a Horse Guards parade. It's approaching Whitehall, really places to people outside the UK perhaps just names on the Monopoly board. But this is the Queen showing her old adage, she needs to be seen to be believed. The coffin's going to arrive at Westminster Hall, and it will be, she'll lie in state until Monday when the funeral happens, and people are going to be able to file past and pay their respects. They've been queuing for days overnight despite the rain, despite the warnings of a 30-hour queue. But really, this is the magic of monarchy, isn't it? The king is going to begin his reign with this sharing of the national outpouring of grief. You've got this king flanked by his children, his siblings, on foot behind the coffin. It really is a symbolic moment, and it evokes the memory of when Charles and William, when William and Harry walked behind their own mother's coffin 25 years ago.
Lizzie, I would say the imagery right now, and for those of you on radio, it is as you would expect, except we're seeing generational imagery. This is really the first time, Lizzie, we've seen the generations of her descendants together.
And I couldn't hear anything.
I think we're having technical problems. Okay, thank you.
We've lost Lizzie Burden.
That happens.
From Abington Green.
With 400,000 people there, that can happen.
So, Tom, a deeply emotional moment for this country. The Queen's coffin making its way to Westminster Hall, followed on foot by senior royals, the royal family, including the King for that matter as well. Tom, as I mentioned a little bit earlier this morning, this walk from Buckingham Palace up the Mall, through Horse Guards Parade, through Horse Guards Arch, onwards through Whitehall, Tom, onto Westminster, can take 15 minutes or so. This is taking about 40 minutes, giving everyone the opportunity to pay their respects as the Queen makes that final journey, Tom, to Westminster Hall.
And the compression here, John, I think for so many, particularly in America, including myself, we don't understand how all of this bureaucracy of government over centuries is all compressed into this square mile.
So where they're going through Whitehall at the moment, Tom, they are the offices of government. And then on to Westminster and the House of Parliament and the buildings that you're so familiar with. Lisa, we did this walk together just on Sunday mornings. I've said a couple of times already. It is the final journey of this Queen to Westminster Hall, where she will lie in state for 5 days, from today through to Monday morning. The opportunity for this country to pay its final respects to the late Queen, Elizabeth II.
the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, September 14th. Here are the top market stories that we're following for you at this hour. Investable or tradable equities try to recover from their worst day since June 2020. Cash positions high, sentiment low. We break down if this is actually a market you can invest in. And hedging risk. However you invest, protection's key. We're going to talk to the expert, Universa Investments' Mark Spitznagel, manager of the best-known fund protecting against black swan events. And the looming railroad strike. 125,000 workers could walk off their job by Friday. Some railways have stopped moving certain products and big-ticket items like cars. It's the latest risk to the U.S. economy. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I'm not surprised that we have a little bit of a relief rally underway here. S&P's up by 0.4. I'm just really worried about how long this lasts. So yesterday's damage can't be undone that fast.
It is tiny, considering the scale of the damage that was done yesterday, and I know if you take a step back, you need to see it in the context of the last 5 days, and equities over the last 5 days still have done okay. But nevertheless, this is not a convincing bounce. This is not a market that is sort of signed off on what happened yesterday and is able to move on from it. I think there's still a lot of shock in the system here. And I think the question is exactly spot on, Alex. Is this a tradable market? Is this an investable market? If you are thinking about the long term, and I'm hearing the word cash a lot right now, if you're thinking about the long term, are you brave enough? Are these markets in a position to accept your money if you want to make long-term investments? And I'm not sure we know yet what that picture looks like. I don't know what you think, but I don't think a S&P that's up less than 0.5% today is certainly signaling the all clear.
But we did have retail buying come into the market yesterday. Like retail investors bought stock-focused ETFs. They bought big tech. So there is on the retail side some kind of buy the dip. We also get options expirations on Friday. So it's going to be hard to make a lot of sense over the next 72 hours.
I think it's hard to make a lot of sense out of any of this.
That's true.
I think it's a real struggle, and I think people are really, really finding it hard to get their arms around what is happening here. QT hasn't even kicked in yet. We still don't know what that liquidity draw is going to look like. There's so many unknowns here. They're known unknowns, but they're still unknowns. So price pressure, certainly the factor that we've been watching over the last 24 hours. We had the US CPI number yesterday. We were digesting it. We were starting to get the scale of the move that we saw yesterday underway right now. Today we get PPI, echoing in many ways that CPI report. Let's get a reaction from some of the people that we've been speaking to over the last 24 hours to this data.
75 is certainly going to be on the table there in November.
The Fed will now have more of a reason to go 75 basis points next week, and I think that's what they'll do.
We're going to see higher and higher rates if these CPI numbers keep on coming this way.
I think markets overreacting to this.
The Fed isn't going to blink.
The stock market doesn't necessarily reflect the state of the economy.
So, question of the day. The president taking a lot of shade for what he said yesterday on the inflation story, putting a positive spin on it. Joining us now, JC O'Hara, MKM Partners Chief Market Technician, to give us a sense of what the market looks like from a technical point of view. 3,900 is a really big line in the sand, and it's holding. We're above it now, 39.46. Can you just tell me how important this line is, and kind of what happened yesterday from a technical point of view that we can make useful decisions based on from here on in?
Absolutely. 3,900 is a key line in the sand for anybody who follows price action, right? There's a lot of news out there. There's a lot of, talk what the Fed's going to do, what inflation looks like. But let's pay attention to price. And if you go back to the highs that the S&P 500 made in January of this year, and look from where it is now, we have a series of lower highs in place, right? That's the definition of a downtrend. So forget if we're in a bull market or bear market, the S&P 500 remains in a downtrend longer term. Now, short term, coming out of those June lows, the S&P has a series of higher lows in place. So that's a short-term uptrend. So we're now at this junction where the short-term uptrend is beating a longer-term downtrend, and that's typically where the waters turn very turbulent. So the S&P 500 right now is very fragile. And that 3,900 level we talked about, if we breach that to the downside, well, then all of a sudden those higher lows that we've seen out of the June low Now we have a lower low. So that just confirms the longer-term downtrend is still in effect.
So many agree with you even on a fundamental basis that June maybe was the low, but we could retest it. Why is the VIX then at 26? Either we're hedging differently or the VIX isn't accurately reflecting what kind of lows we may see in the stock market.
Well, the VIX is right, it is a measure of volatility. And what I find interesting is looking at price versus the 200-day. And what we found was when the S&P 500 is trading below its 200-day, the VIX on average is north of 27. Now compare this to when the S&P is above its 200-day moving average, the VIX is 16. So we have a 65% higher VIX if you are above or below the 200-day moving average. And basically all that it means is you have more risk at these levels. You have greater left tail events. You have greater likelihood for moves that we've seen yesterday, right? When the waters become more choppy, that doesn't mean the June lows can't hold. That just means we're in a bottoming process. But that means risk is still very much well and alive right here. So we have to be cautious even if we are bullish.
Is the bond market dictating what equities should be doing right now, particularly the front end of the curve? And is the equity market listening?
Absolutely. We all know the saying, the bond market is always right. And whether that is indeed true or not, I believe it is vital. If you're an equity investor, we need to pay very close attention to the front end of the yield curve, specifically two-year yields. Now, obviously, they are very tied to what the Fed is thinking, what the Fed is doing. But what we found interesting is, if you take 40 or 50 years of data and you look at the peaks in two-year yield, when the two-year yield reached a plateau and then it started to roll over, what we found was that front ran what the federal funds target rate was by 150 days. So it is a leading indicator to the Fed thinking and what they are planning on doing. And when equities see that the two-year is rolling over, obviously it broke out yesterday, when equities see the two-year actually peaks and rolls over, historically, that is when equities thrive. So yes, equity investors should pay very close attention to the two-year because right now, it's very difficult for equities to move higher meaningfully with two-year yields moving higher as well.
What is the top then in two-year yields? What's the chart telling you?
Well, we have to look at, what the terminal rate is for the Fed funds. And, that keeps moving up, especially with the recent inflation data. So right now, two-year is, at 3.8%, give or take. I mean, we probably should expect the two-year to creep higher above 4 and maybe even 4.5%.
All right, JC, look, we really appreciate it. It's a great way to set up. We are watching that 3,900 level in the S&P. Calling it fragile feels very real right now. JC, thanks a lot. JC O'Hara, MKM Partners, Chief Market Technician. Thank you very much. All right, that's the technical. Let's go to the fundamental. Is it too early for investors to go back into the growth trade? I just mentioned that retail was in there buying some stock-focused ETFs, particularly tech. We're going to take the question to Zachary Hill, Head of Portfolio Management at Horizon Investments. This is Bloomberg.
When U.S. inflation numbers are released,
A stunning inflation report.
Bloomberg brings you crucial data at terminal speed.
Core rises 0.6%. That is double last month.
And instant expert analysis.
There goes Goldilocks.
Republicans are really going to harp on that. This is about a narrative shift in markets.
There clearly isn't going to be a pivot anytime soon.
Sooner or later, they're going to make a policy mistake.
Ouch for America, but double ouch the rest of the world.
Nobody covers the economy like Bloomberg, your global business authority.
The Fed has a game plan. Their game plan is to make sure that the interest rate is higher than inflation. That's the way they believed the way to kill inflation. So you have 8% CPI, that means you have to have 9% interest rates. So we're going to see higher and higher rates if these CPI numbers keep on coming this way.
Might have been the biggest call I've seen there in terms of what rates need to be. Mark Mobius of Mobius Capital saying the Fed is not going to blink when it comes to raising rates. The Fed's tightening looming over the markets after yesterday's CPI print. So that leads us to the question of the day. Is this an investor's market? Joining us now is Zachary Hill, head of portfolio management at Horizon Investments. Zach, can you actually invest in a tape like this?
Well, it's been really challenging all year, and I think it's important to kind of frame where we are. The last 10 or so years, the Fed has had your back. They were concerned primarily about growth because inflation was not a problem. And we think it's just the exact opposite situation today. I mean, the Fed, for all intents and purposes, is a one-mandate central bank, and that is inflation first and foremost. And so, from our perspective, the fact that we put pivot to bed, Powell did a few weeks ago, is refreshing because we think markets are starting to get the idea that this is just very different than your old Fed for the last 15 years or so.
So what does that mean for investors? If the penny hasn't dropped completely for everybody yet, are we able to make long-term decisions? We have a lot of volatility potentially in front of us. Is it possible at this stage, Zach, to look through that volatility and make investment decisions on a 2-year, 3-year, 5-year horizon?
Well, we have to. That's our job. Well, I think a couple things that we're looking at in terms of the near-term volatility picture. A lot of people are focused on the VIX, and certainly your last guest was talking about the VIX in the context of capitulation. We just don't think that's the right framework. We're actually paying more attention to interest rate volatility. Mm-hmm. That's been the driver of uncertainty across markets, and so we've seen a little bit of healing. If you look at front-end volatility has come in a little bit. It's still got a long ways to go, but that we view that as positive. And also, that idea that there is not a pivot, that means that the central bank's reaction function is pretty straightforward, actually. And so over time, we actually think that that's a vol dampener because investors will start to internalize that rather than trying to make the decision, is it growth, is it inflation, is it both, which we have not been thinking about in our portfolios really all year.
Hey, Zach, how much cash do you guys have right now?
Well, it's going to depend across our strategies, certainly, and we're very positioned defensively across equities and fixed income. It's been that way basically all year. But I think importantly, especially on the equity side, we have been rotating a little bit from, some of your more traditional defensive areas like staples and utilities. Those have done a lot of work this year, and so we have been starting to, kind of nibble back into some of the higher quality parts of the market, and that does include parts of the kind of the mega cap tech that's been so much in focus. We're being careful to kind of avoid the really speculative names that are very sensitive to discount rate, but at these valuations, some of the really highly cash flow generating names start to look a little interesting.
When you talk to investors, when you talk to your clients, what are they saying to you in terms of their tolerance for risk right now?
Yeah, this is a great question, and our clients are primarily retail clients. And one of the things that when we talk to clients, we generally would see in a market like this, when both equities and fixed income have just been relentlessly down all year, we would hear a lot of panic typically, and we haven't actually heard that. In fact, we've heard some people, hey, is it time to buy the dip? How are you thinking about that? Can we get back in? Everything's on sale. And so kind of when I look at that, I say that we really haven't taken that kind of broad-based pain that it's typically associated with bottoming process, where instead of trying to buy the dip, you're almost in a state of despair. We haven't really heard that from our client base. And while the professional investors may be in a position like that, certainly retail, which has been a more important part of the market over the last few years, they're not thinking that way.
Hey, Zach, do you know why? Is it that there's more money to be put to work from the retail investors? Is it because they got too conditioned to buying the dip? Or is this like a fundamental sort of shift?
I think a lot of it is conditioning. And really, if you zoom out, over longer time periods, returns across broad equity markets have been really attractive, 3-year, 5-year. And so, we haven't really seen that real kind of the despair, equities no longer work type situation, which, to be clear, like, we do not believe, especially, within the United States. But as our, reading of our client psychology, we just really haven't seen that yet, which I think is really interesting and telling.
What do you think would cause that psychology to change?
Well, it's tough to say. I mean, certainly, if we kind of retest the lows and go through there, 3,600 or so in the S&P, that might get some people's attention. The other thing, too, is just time. The longer that we stay down, or this idea, and certainly in the media, people talk about, are we going to make new lows or new highs, like it's some binary type of situation. There could be a situation where stocks just chop around for a while. And we think that actually would be ultimately a healing, kind of a good process. But that just takes time, and so we're not quite there yet.
So, Zach, does your clientele care if the Fed hikes to 4% for a while and stays there? Like, are they looking at it as closely as we have to every day?
No, I don't think they are. I mean, certainly, that is our expectation. After that really abominable print yesterday, we're, likely to see rates 4%, maybe a little bit higher at the end of the year. And I think importantly, that's going to, push back these cuts that we've seen in the market. That's been helpful. Over the last few weeks, the market has kind of come our way, but we think that has more to go. And that is a kind of a time conditioning type of situation for, equity investors, especially because, buy the dip, don't fight the Fed, has been the way to manage money for the last 10 years or so.
Absolutely. Maybe a new paradigm in place now. Zach, great to catch up. Zachary Hill of Horizon Investments. Really appreciate the insight. Okay, what have we got coming up for you? We've been talking about inflation, and now we've got something that could add to it. We've got a railroad strike that could be possible in the United States. We're getting used to them over here in Europe, certainly here in the UK. We'll talk about that next. I want to take you down to Westminster as well. What is happening there is a service that is taking place that will basically start the process of the Queen lying in state in Westminster Hall. You're looking at live pictures there. We've also had a headline within the last couple of minutes that President Biden has spoken to King Charles III. I'll leave you with these shots from Westminster.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Comcast is doubling its share buyback program to $20 billion. The parent of NBC Universal is taking advantage of the shares having lost a third of their value this year. Comcast has already bought $9 billion of its stock in 2022. Global tech investor SoftBank reportedly is considering the launch of a new giant startup investment fund. According to the Wall Street Journal, it's part of a plan to rebound after the poor performance at its two earlier funds. SoftBank has been hit hard by the rout in tech stocks. It posted a record $23 billion loss in the quarter ending in June. And a strike set for Friday could prevent American railroads from transporting farm products and other key goods. It could cost the economy $2 billion a day. President Biden is personally trying to break the logjam between railroads and labor unions. Labor Secretary Marty Walsh will meet with railroad and union representatives today. And that is your latest Business Flash, Alex.
All right, thanks so much, Ritika. Let's get more on the rail strikes and how they can actually make inflation worse. Bloomberg's Michael McKee joins us now. So, Mike, I know you're going to say that a lot of times these strikes get resolved at the last minute. Okay, let's pretend that we know that for a second. In the meantime, what kind of goods have stopped being transported, and then what's the economic and inflationary effect?
Well, they've already stopped ammonia shipments, which are a key ingredient in fertilizer, and that's a big deal for American farmers because ammonia is so volatile. They don't want it sitting around in tank cars if all the trains have to stop. This afternoon, Norfolk Southern is going to stop taking deliveries of cars at its rail loading sites, so the automakers are going to not be able to transport new vehicles to dealers. And we've already heard Amtrak has canceled some of its long-distance service that runs over freight railways, freight-owned rail lines. So we're already starting to see some effects, but it's obviously, if this goes through, going to be a much, much bigger impact. As much as $2 billion, as Ritika said, a day, according to the American Railroad Association, and 28% of U.S. freight, which would account, according to the American Trucking Association, you'd need 460,000 additional trucks a day to make up for that capacity.
It's a lot of trucks. Mike, one of the things that a lot of companies learned during the pandemic was they need bigger inventories. Is that inventory cushion still there, and will it protect firms from a relatively short-term strike?
Well, it goes industry by industry, and a relatively short-term strike probably won't hurt all that much because there are stocks and they could rebuild them. It will just stretch out that process. Biggest issue coming up is going to be agriculture because it's almost harvest season. So trying to get grains, et cetera, to where they need to be is going to be a major issue if this should happen and drag on for a little while.
Can we ship the stuff? And I ask because the Jones Act requires that you ship stuff in the United States but with a U.S. ship crewed by U.S. personnel. They've been trying to get that repealed for quite a bit in terms of, say, petroleum products. Is that an option right now that people are talking about?
Not yet. It is not a major issue yet because most of what we're talking about goes inside the United States back and forth. But to the extent things are shipped overseas, because they are going overseas, they can use foreign flag vessels. They just can't go from U.S. port to U.S. port. So at this point, it's not a major issue. I did forget when you asked about things that are going to be canceled. One of the things that's going to happen, like Amtrak with its freight railroad lines, any commuter rail lines that go over freight lines could be shut down, and they're talking about that for Chicago. They're talking about that for Washington, D.C. So a lot of people might not be able to get to work.
A lot of people have learned lessons on that front. Working from home has become more normal. It's certainly something that we've got very used to here in the UK. As the strikes have taken place, people have just gone, you know what, I'm going to fire up the office system at home. We're good to go. So it's going to be interesting to see what impact that ultimately has. Mike, boil it down for us. What impact could this have on PPI? What impact could this have on CPI?
Well, nothing yet, but it's going to, if it happens, it will have a major impact on CPI because transportation costs are included in the retail final selling price. PPI not so much because PPI is what you pay the producer when it leaves the factory gate before it gets on the train. So that won't have as big an impact. But you look here at, this is the kind of chart of the day, I think, for inflation. The purple line shows the number of products that are experiencing a more than 4% inflation rate on an annual basis, and that's up to 60% of what's in the CPI. It shows how broad-based the inflation pressures are. So the last thing we need is something else that adds to inflation.
Mr. Mike McKee, thank you very much indeed. The rail strikes are coming. Honestly, Alex, I feel like this is something that I've been talking about for quite some time. It has been a big issue here in the UK, and it's mainly been an issue for travellers, but it's also been an impact for freight. We don't move as much on the rails here, but nevertheless, it is having a meaningful impact, and it is something that is slowing the economy down.
And here, I mean, the last rail strike was 30 years ago. Like, this is not something that we've been used to, and you have to wonder, it can't be in isolation. There's a reason why they're striking now, and you have to wonder, as we've seen in the UK, the spread of strikes more and more and more.
Absolutely. We've got some great guests coming up. Let me just flag those as well. We're going to speak to Mark Spitznagel, University Investments founder and CIO. He's next. This is
This is Bloomberg.
So we're an hour into U.S. trading. It's not ugly, but it's not pretty. We're hitting session lows on the S&P. We're only down by around 0.3%. Let's figure out what's going on. Abigail Doolittle, over to you.
Guy, I would say it is wobbly because at this point we did have the S&P 500 higher earlier on the open, up almost as much as 0.6%. That, of course, after the greater than 4% sell-off yesterday, the worst since June of 2020. Now we're down about 0.3%. Similar to yesterday, volume is above average. So investors really trying to figure out what's next. Now, one factor